What we want to do is go over real estate modeling. It's sometimes boring, but it is the nuts and bolts of the business, meaning, do all the negotiations, do all the ups and downs, emotions of doing deals and finding deals and growing your capital, meaning raising money. You have to know the numbers at the end of the day. And what we want to do is break it down into really, really simple steps. So all these complicated Excel spreadsheets, you could get into 100 different sheets inside one file, but really what it comes down to is 5 inputs. 5 inputs is all it is that you need to know in order to make a decision on a real estate deal. Is it a good deal or is it a bad deal? So the first 2 is you got to know the income and you got to know the expenses. Those are the 2 things that you have to know on any asset. Okay, and then you also have to know what's the cost basis of the asset. What are you paying for it, plus all the improvements, plus all the closing fees, everything all together, what's that total cost basis? And then you got to know what type of debt are you getting. Do you have one loan? Do you have a couple loans? What's the debt structure on the asset? What's the interest rate? What's the term in terms of how long is the amortization? When is the loan due? And then the last thing is what's the cash required to close the deal? Those are the 5 things. That's it. People overcomplicate it, but if you know those 5 things, you can get a basic determination of what's the cash on cash return. That is the number 1 thing you want to know. Within years 1, 2, 3, 4, 5, everybody models most of these assets, their performance on a 5-year hold. What is the cash on cash return on that investment? And that means not what the value is at the end of the 5 years. It means the year 1, how much money is distributed into your account or into the investor's bank accounts. That's cash on cash return, money that's actually distributed. And then you look at the internal rate of return. And that's just a complicated way that basically means of saying, what is the average return over that 5-year period hold, over the life of you holding that asset? What's the average return year over year if you tally up all the cash flow and all the proceeds from a sale or refinance? So if you hold it, you take all your distributions through cash flow, you sell it, you get one big payout, you add all that up, and you divide it over the 5 years, that's going to give you what your average rate of return is, which essentially is your internal rate of return. Those are going to tell you the basics of if a deal is successful or is it not. Lastly, so when you're evaluating these 5 inputs, so when you have your income and your expenses, what that's going to give you is the net operating income. That's going to give you how much profit, what is the yield that you get from that asset after you collect the income and after you pay the expenses. Once you know the net operating income, that is the metric that all commercial real estate is measured by. This is how you determine value. So you apply a rate of return or a cap rate to that, and then that determines what the value of the asset is. So I know that's a little bit of a complicated way of explaining it, but what it really means is, in an even more complicated way of saying it, is it's your unlevered yield. So if you bought the property and it brought in $1 million of income and you had to pay $500,000 of expenses, your net operating income is $500,000. So right there, what are you willing to pay for this property for it to generate $500,000? And you have no loans, this is no debt, this is the profit you generate after you run the business or run the property, collecting revenue, paying expenses. That's your net operating income. Now from there, that's where you determine the value. And this is subjective. This depends on what interest rates are, what the capital market's appetite is, like how hungry are they for investments. If there's a lot of appetite for these assets, say it's a McDonald's lease on a 30-year, it's a McDonald's property on a 30-year lease, that is a very, very safe, secure investment. So investors would be willing to pay a very high price for that stream of income, that $500,000. They may pay a huge price for that small amount of income, but if it's a risky investment or if it's a challenging investment to operate, say like a ran down, crappy old mobile home park, they wouldn't pay a lot for that stream of income. They're only going to pay $1 million for that stream of income, or a very low multiplier. So the point is, a cap rate is subjective. It determines what the value is of a property, and this is how appraisers, investors, how banks, how we all measure the commercial real estate industry and determine value. But if you know these 5 inputs, if you know the income and expenses, if you know the cost of what you're buying the asset for, if you know the debt that you're getting on the asset, and you know how much cash it's going to take to buy it, then you can really figure out how successful this asset's going to be. And then you can also figure out, is it really worth the price that they're asking? Or is it not, based on the security of the investment or the quality of the asset based on all the stuff you got to do to improve it, all the management you have to do. There's so many factors around actually running the piece of property, but that will give you the basics of modeling a real estate property. Thanks.